Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where my guest is David Keir, Managing Partner, Dundas Global Investors. Dundas Global Investors is one of Apostle Funds Management's affiliate managers. Apostle offers Australian and New Zealand investors access to global solutions and world-class managers. First of all, David, it's a great pleasure to welcome you back to Australia.
Many thanks, it's great to be here.
David, first of all, I think it'd be good to take us through who are Dundas Global Investors and what's the firm's approach to investing?
Yeah, sure. So we're an investment boutique based in Edinburgh in Scotland, as you say. There's 15 of us in total, of which 9 of which are partners, and we in effect run the business. And we have a simple, straightforward philosophy. We believe in dividend growth investing. And we take a very long-term view with average holding periods well in excess of 5 years. But the most important thing is the alignment between ourselves and our client through us co-investing with our clients.
And the unique approach with dividends, it sometimes seems that the dividend isn't focused on enough, and there's all sorts of approaches, although it does inform the value style, but growth and various other approaches. Is it fair to say that it's something of an old-fashioned way of viewing a company?
I think dividend yield investing is, so that's dividend income today. We're a dividend growth manager, which is something very different. So let me just talk through that for you. So in effect, we're a quality growth manager with dividend growth as our North Star. So we want to invest in companies that can sustainably grow their revenue, profits, cash flows, and ultimately dividends for long periods of time. And the reason we do that is that dividends, predominantly dividend growth, are the largest drivers of long-term equity returns. There's lots of different academic studies out there that talk about the power of dividends and dividend growth. And the one we'll talk about today is the MSCI survey. And that shows that as your holding periods increase, the driver of long-term equity returns from dividends and dividend growth increases. So for example, over 1 year, if you break down the different componentry between valuation, dividend growth, dividend yield, there's about a 50% return between valuation and dividends. As you stretch out towards 10 years, these parameters change. And actually over 10 years, 80% of your long-term equity return comes from dividends, with dividend growth being the primary driver.
So when we look at that in terms of the payout ratio, the payout has gone to the investors and that's part of their total return, but are you effectively saying that it's the compounding of that retained portion of the payout that really builds over the long term value and capital growth within the company?
That's it. It's all about the power of compounding. So if you look at our companies, on average, our companies over the life of our fund, which is going really now 12 or 13 years now, our payout ratio is around about 35%. So when we think about payout ratios, for us, we look at the retention ratio. So that means 65% of the earnings on average have been retained to reinvest in the business to drive tomorrow's growth. Now, one thing people always ask us is about, okay, so why dividends and not earnings? And the real reason for that is that dividends are real and are paid. You can touch and feel them. Whereas earnings can be manipulated and are not paid out. And as a Scottish accountant, looking at these things, I like to be able to touch and feel the pennies. And we're very, very clear that financial engineering has no place for us.
And there's also the aspect of control that obviously a company's share price is not within its control. And its profit, maybe it can manipulate various accounting treatments of its profit, but its dividend is one thing that it does control.
Absolutely. And the key thing for us, when we look at our companies, how do we measure long-term progress? And we measure it by the annual dividend declarations. As I said already, these things are real, dividends are paid, they're cash. Another thing is why dividends? Because we think dividends gives you extra things, such as it's a covenant between management and shareholders, which should only be broken in extravagance. Dividends should give you better capital discipline because in effect it should stop vanity projects and it should stop companies allocating 100% of their profits into projects that might not give you the return that you want. It also should lead to good corporate governance. Paying a dividend gives good corporate governance. And the other thing, of course, is the link between the past and the future. We think it's a very good signalling technique. We call it an oath of optimism.
Take us through the process by which Dundas seeks out quality growth companies that fit these criteria in terms of your universe, your shortlisting, sector responsibilities, and how do you end up with the portfolio?
Sure. So I guess the first thing to say is that we're all generalists. So we come at this from having no great sector expertise, but we build that over time. The second thing to say is that we do it all collectively as a team. So what we do is we will go around the market looking at various sectors or subsectors as a team for a period of time. And we basically look at all the companies and we sift through these companies, learning from them all, and try and sift those down into a smaller number that we can look at in depth. And we spend a lot of time looking at the smaller number in depth, using our own proprietary tools, such as the grid, to try and hopefully identify these companies that are capable of the sustained revenue growth, profit growth, and ultimately dividend growth, but at the same time having that payout ratio which enables them to reinvest in the business to drive tomorrow's growth.
What was the situation not that long ago when a lot of the major US tech companies really weren't dividend payers? Famously, Bill Gates said at one time that the share price is the dividend, i.e. that's your total return. Did that suit the approach, or are those sectors like that just really can't be part of your world?
So I guess take a step back and say, what are we looking for? So we want companies that can sustainably grow their revenue, have high margin structures, good return structures, strong balance sheet, good cash flow, and that payout ratio being key, which enables them to reinvest in the business. So good reinvestment in R&D, CapEx, and M&A. Okay. Now the reality is that there's not, if you think about the indexes, not all companies in the index will have these sort of characteristics. So there are certainly some sectors that we tend to avoid in general because they don't have the characteristics. They tend to be price takers, higher payout ratios, lower growth. And those tend to be things like, whether it be utilities, real estate, oil companies, etc. We tend to find this dividend growth that we seek, and these quality growth companies with dividend growth are North Star, tend to be in the more healthcare, technology, and also some financial companies as well.
Take us through an example of a business that has had strong and sustainable return growth, as demonstrated by dividend growth. I would imagine I'm really asking you just tell us, pick one stock from your portfolio and tell us about its growth track record.
So I think a really good example would be American Express. Okay, I'm sure many of our viewers will have American Express cards in their pockets, something that's well known to us all. And the reason it's so good is because it's quite a simplistic example. So this has been in the portfolio since the launch of the fund. And at the time when we bought it for the portfolio, it had a price earnings ratio of 18 times and a dividend yield of 1%. If we forward wind to today, it's got roughly the same sort of valuation metrics of a price earnings ratio of 18 and a dividend yield of 1. But we've had an 11% return per annum from that. So how have we had that? And the reality has been the power of that dividend growth, which has matched earnings growth. So American Express has grown its dividend at 10% per annum over that holding period, plus the 1% yield gives us our 11% total return. And that is how dividend growth investing works.
Are you agnostic about geographies or sectors? The portfolio really comes down to the stocks that you can find that fit your metrics?
Absolutely. So we have a global bar for investing. We're trying to find the best 50 to 65 dividend growth companies across the world. We don't care where they're listed. What we care about is they have the metrics that we seek. So when you look at our portfolio, if you broke it down between a US and a non-US portfolio and looked at the metrics of revenue growth, profit growth, dividend growth, they're very, very similar.
What about in terms of company size? I suppose a better way of asking that is what is your bottom limit for market capitalisation?
Sure, in general the rule is very roughly about $10 billion market cap. We tend not to go below that, and that's predominantly for liquidity reasons.
David Keir, Dundas Global Investors, thank you very much for your time today.
Thank you.